Let's now turn to private credit and how attractive is Southeast Asia and Australia for global investors. Alan Greenstein is joining us from Zagga. Alan, welcome. Good to see you.
Good morning. Thank you.
Tell us what you do there at Zagga. So, alternative real estate investment manager, essentially.
Yes, we're a private credit fund. We operate across the commercial real estate debt capital stack, offering finance to developers and obviously investment returns to investors.
All right, but you've got a presence across the ASEAN region then, have you?
Yes, we have been working that region for a good couple of years, starting in Japan about 3.5, 4 years ago. More recently, we have set up a presence in Singapore. We run a fund out of Singapore, and we have a representative in Hong Kong as well, and are beginning to work Korea, especially in Seoul now.
All right, so in that region there, where are you seeing the best opportunities at the moment?
So I think for us, the opportunity is not one of lending into the region, the one is finding the money in the region. There are more and more investors who are interested in Australian commercial real estate debt. Singapore is obviously a hub, attracts a lot of capital, not only from People's Republic of China, but also now from Taiwan and other places. Dubai money is beginning to come into Singapore, so Singapore is beginning to become a collection point for a lot of wealth, and larger components of that wealth are now beginning to look at Australia as a good home for their money.
And why is that? Why Australia?
I think there are a few reasons. Reason number one is that the traditional home for Asian wealth has really been America and Europe. In the last, say, year or so, the American story from an investment point of view has probably become a little bit less attractive. I think some of the funds, some of the investors have felt that they have overexposure to that market. Obviously, the US Fed started cutting rates way before anybody else. And more recently, the Trump effect, tariff uncertainty, all those kinds of things. The opposite side of that coin is from a commercial real estate debt point of view, Australia is a fantastic market. We have a burgeoning commercial real estate debt industry. We have a net housing shortage. We have net positive migration, I think 600,000 last year. We're going to be building new homes for a long time to come. And with new homes comes a lot of other opportunities. So the market is strong from an economy point of view, no matter what we may think about recent changes from a global perspective, from a macro perspective. The economy is still good. We are AAA rated by Standard & Poor's. We've got a fantastic legal system. We've probably got one of the friendliest lender jurisdictions in the world. We're English speaking. We're sophisticated, so it's a good home for money. And I think from a Singapore, Hong Kong point of view as well, Australia is a jurisdiction that is known to a lot of them. They've been educated here, some of them live here, they have businesses here, so it's not a foreign place.
And Alan, we are now in a rate cutting cycle. Is that likely to be a tailwind then?
I think that it's going to be interesting as to what happens with rate cuts, but I think rate cuts are going to be a global phenomenon, not only an Australian phenomenon. And if you look at our fund, for argument's sake, since 2019, we've always managed to return at least 5% above whatever the cash rate was. So I think if you're an investor and you're looking at your margin over cash rate, remembering that when rates go down, your returns with the banks are going to go down as well. If we can keep that margin, I think that's still attractive for investors, not only here but across the world.
What risks would you be considering at the moment, particularly with Australian real estate? Looks at residential real estate developers. So many have gone bust in the past couple of years. Do you feel as though that's now the tide has turned? It's a little more stable. Nonetheless, do you still see risks there? Look,
I think there are always risks when you're lending, and when you're lending into development, there are more risks because there are lots of things you can't control, specifically the weather, and all those kinds of things happen. So I think lending is all about the management of risk, not about the avoidance of risk. And for us, we lend into a very specific niche in the market where we believe the market is deepest and where we believe the risk management and the risk mitigation is the best. Certainly, the ABS statistics suggest that there have been a lot less insolvencies amongst builders and amongst developers in the last year and a half. That's more now in hospitality and leisure. I think a lot of those insolvencies were COVID related. That is out of the market. A lot of those insolvencies had to do with very large builders and home development companies, and we're not looking at that at all. And the market is very big. I mean, this is a market that is sized at around about $100 billion a year. So I think there's lots of room for good business to be done. And I think for an investor, whether they're from Singapore, Australia, the US, wherever they are, I think the key message for them is to do their homework very, very diligently into the investment manager. That's really where the secret is. Riding the jockey, not so much riding the horse.
How would you describe the maturity of the private credit market here? Because it's certainly it's been a more recent phenomenon that we've seen capital been attracted here and turn here, particularly as from a retail perspective as well.
Yeah, so we're not in the retail space, but there is no doubt that retail investors are beginning to look at this for the returns. But if you have a look at the US, private credit is about 50% of the market. If you have a look at Europe, it's about 40% of the market. At the very last report that I looked at, we're only around 17 or 18% of the market. The banks still have 83% market share. So $100 billion a year equals 17%. That suggests to me there's a lot of room for growth. So from that point of view, I wouldn't necessarily call it immature, but I would call it fledgling. But from a operator point of view, from an expertise point of view, there are some very, very mature, very good operators in the market. And if you have a look at the mandates they're attracting from some of the large sovereign wealth funds and the larger funds, they clearly know what they're doing and they're able to compete on a global scale. So I would say this is a market that is going to continue growing. And like for all investors, you shouldn't jump into every stock you see or every investment product you see. It's got to be fit for purpose. It's got to suit you.
Do you see a distinction between particularly Australia and the US, whereas the US, well, I think majority of private credit lending there is to business, whereas here it's more about real estate?
I think that is a factor. I think that's a factor. The US market is very deep, very big, very sophisticated. Is marked to market almost every day. There's a lot of leverage in that market, and there's a lot of room, to sell down into that market. The Aussie market, from a corporate point of view, is much smaller, but it's there. But Australia has always marched on its property stomach, and I think that the natural private credit product here is property. So from that point of view, I do agree there is a difference. There are certain commonalities that one needs to look at. It is a private market. There is a premium for illiquidity. If you want liquidity, this is not a market you should necessarily be in. You are dealing with private debt, and that is different rules to public markets. But if you have a look at the trend around the world now, and I've just spent a week in Singapore, I was at a couple of conferences there. I'm going to a conference in Korea next week. There is a massive swing from public to private markets. So this is something that is interesting the world right now.
And as a result, so you've just unveiled a new private credit fund then, have you?
Yes, we've been working on putting up an interesting VCC structure there for a couple of years. We have just launched the Zagga Real Estate Credit Fund over there in Singapore. It's a VCC fund, which means that it enjoys the benefit of being tax-free to Singaporean investors and also has the benefit of being able to be exempted from non-resident investor tax over here. So it's a straight-through coupon. We have found that there are many, many Singaporean investors who want to invest in Australian real estate private credit, but don't necessarily want to convert into Aussie dollars. So this fund allows them to invest in Singapore dollars, in Hong Kong dollars, in US dollars, or in Aussie dollars, and also gives them the benefit of the tax-free return.